Welcome back. Our next guest says now could be the right time to buy stocks, but she advises limiting China exposure. Let's find out more from Laura Lau, Chief Investment Officer at Brompton Group. Thanks for coming in.
Thanks, Paul.
Investors are wondering if we are close to a market bottom, and I guess they're wondering it as markets plunge again today after the big boomerang of yesterday. What do you think?
So I think that we are in a bear market. There's ways to define a bear market. Usually, when the market's down 20% or more, and the S&P did achieve that intraday. But the other way to see it is basically the volatility. We got this big spike up yesterday. We're getting spikes down. That typically is more a bear market. So how long do we think it'll last is the other question. So what we would characterize this is a event-driven bear market. What we mean by that is it's obviously caused by tariffs. And if it's event-driven, like in the past, think about other event-driven markets like COVID. And that came back very fast.
Right.
And will this come back fast? So that's the question. How long will it last? And nobody really knows, because nobody really knows what Donald J. Trump will do. And what kind of retaliation there will be. Like, say, with China, we've got more tit for tat. And neither party seems really willing to sit down and negotiate. And what we feel is that, U.S. still believes China is a rival. And when you think about it, after Trump 1.0, he put tariffs on China, not really other countries, and they're still on today. And they're being escalated. So that's why we'd say, China-related exposure, you probably want to stay away from, but it's not easy to do. Because when you think about it, a lot of imports in the U.S. are dominated by China, 70% plus. Things like toys, electronics, TVs, computers. It's really hard to source alternate sources
What
to
would
that.
you think in that context, for instance, of a couple of stocks like Walmart, which gets a lot of its products from China, and there's been headlines on that. Walmart has, in fact, gone to Chinese suppliers and said, give us a break on price. That was not received very well in China. So Walmart's an interesting story. So is Best Buy, the big retailer of electronics. How would you think about those stocks in this context?
So I actually saw Walmart last month, and what they felt was that they would be better positioned than their other competitors, because they are the behemoth, and they would be the last to raise prices. And you've already seen that Walmart has actually kept their guidance, and they've actually been able to increase market share, and they've said that we're going to try to not to pass on. However, Walmart also told me tariffs, usually about 70% is passed on to the consumer. So what they'll try to do is find ways to change the products to make it cheaper. But that takes time to do. So certainly, I do think that Walmart will come out of this stronger, but we're going to have some noise in the meantime. There will be some negotiations. They're going to, and we already saw Amazon cut some of their orders with China, and I wouldn't be surprised if we saw some of that from some of those other retailers as well.
Earnings season, gets underway in a big way tomorrow. Do you believe, by the end of earnings season, will we see earnings forecasts come down for S&P 500 companies after we get all that, all those reports, all that guidance, and all those conference calls from big S&P 500 companies?
Yes, I think we will. And part of the reason is, no matter if you put the tariffs on or off, it's the uncertainty. So with this uncertainty, you have consumers, they're like, should I buy? They don't feel they don't feel that confidence to make big purchases, whether it be a car, house, and costs are going up. So, for instance, for cars, last year we saw the most repossessions out of the U.S. since 2009, the financial crisis. And if you increase car prices another 25%, you're going to have even more pain. Steel, aluminum, you're used in houses. Again, that's going to be, you're not going to do that renovation. So that could, be tougher for Home Depot and some of those. So, and then businesses, we don't know what the rules are. So if you don't know the rules, it's hard for them to make investments. It's hard for them to hire people. So the danger is, will all this uncertainty change an event-driven bull into a cyclical, event-driven bear for tariffs turn into a cyclical bear because we go into recession? There's no doubt GDP forecasts are coming down, and they're going to continue to go down until we get some resolution.
Okay, you do have 3 stock picks in the Canadian market. We may not have time for all of them, but I'll tell viewers what they are. Intact Financial, Fortis, and Thomson Reuters. Why don't you give us your thoughts on Intact, the property and casualty insurer, not a life co, the other kind of life insurance company, and you call it a safe haven in these markets.
So we've seen in the past that property and casualty insurers are a safe haven because you need property insurance, you need car insurance. So we've seen that, the funds flow tends to go there, and the business model is solid, strong return on equity, very good operator. That's where people tend to flock in bad times.
And the stock has held up pretty well, hasn't it? As we look at the one-year graph, it's held up pretty well during all of this. We do have time, I'm told, to talk about those. That's good. Let's go to Fortis.
So Fortis, again, another safe haven. It's basically utilities regulated, almost 100% regulated in Canada, US, and the Caribbean. So very well diversified. It doesn't really matter what happens. They're going to keep on chugging along, 46% dividend growth out to 2029. In fact, over the past 51 years, they've increased their dividend every single year.
Interesting how similar the one-year graphs on Fortis and Intact looked, isn't it? Completely different industries, but as stocks, and as businesses, they have some similarities that investors are really moving to. Both have moved down recently. I assume you see these as being buying opportunities for these stocks, the very recent move down in the share price.
Yes, so if you want to be safe, these are the kind of stocks that you probably want. Or you can, if you want to buy those that have drawn down a lot, you can play that as well. But if you want to be able to sleep at night, I'd say Fortis works, and so does Intact.
Okay. Thomson Reuters, of course, is the provider of specialized information, data, and software to professions like the legal profession, the accounting profession. You like this one as well.
So when you think about it, this is one of the few names that actually can benefit from tariffs and all those legal challenges that are being launched against Trump, because their big business is legal software. Mm-hmm. So they have software that helps you, with tariffs. So that's why they benefit. And also, they're one of the few companies that actually have been getting more and more revenue from artificial intelligence. I would say out of all the professions, legal is one of the ones that can be more disrupted and really have productivity improvements with artificial intelligence, and they benefit from that.
Thomson Reuters up about 140% over 5 years. Laura, thank you very much for joining us. Laura Lau is Chief Investment Officer, CIO at Brompton Group.